In this video, I'm going to show you exactly what I send to the members. If you watch my videos here on YouTube and you're not a member, you'll hear me say that I produce content for my members that ups their game. And this is one of them. And we're talking about the poor man's covered call, where we come up with creative ideas. See, we can get good at this and we can make good money. We can be successful. People ask me all the time, John, is it about the money? And I always say no. It's about the challenge and the success. Money is just the scoreboard letting you know if you're doing it right. This is a video about 3Xing our profit using a 3X leverage ETF using the poor man's covered call. But what I need you to understand is this: we're using leverage, so you need to know how to trade it like me. And that's what I explain to the members. This is what I call a crumb collecting trade. It is an easy swinging poor man's covered call trade, and I'm going to show you in this video what I showed to the members. If you like anything you hear, I want you to go to cptdashboard.com, click Upgraded Dashboard, and get your 1 free month offer. I'm doing another video for the members this afternoon, so I want you to be a part of it. But more importantly, sit back and enjoy what you're about to hear, because I break down the poor man's covered call like you've never heard on YouTube. I talk about things that nobody wants to talk about or even know to talk about, because I've done over 30 poor man's covered calls in what seems to be the last year. So I am absolutely the perfect person you want to talk to or listen to when it comes to using the poor man's covered call. Stick around. I know you're going to like this one. Hey, welcome back, everyone. It is time to talk about the poor man's covered call. We're going to use the poor man's covered call with a 3X leveraged ETF. Now, I don't want you to go running out of the room screaming. We're going to use leverage and leverage. But what we're going to do is this: we're going to create a little crumb collector trade. And what we're going to do is we're going to utilize a 3X leveraged ETF. And yes, I understand we're going to be paying a lot of time value in the cost of that Leaps call option that we're going to purchase. But here's the idea. We're going to talk about how we're not actually going to write covered calls near the money. I'm going to break this down as simple as possible. I'm actually doing this right now with the TQs. And I have a trade here where what I've done, instead of buying the shares, and you can see I bought about 5 Leaps call options to support this trade. Instead of investing 500 times 52.98 when I got involved in this trade, I went ahead and bought a Leaps call option in lieu of buying the shares. I picked the 41 strike and I paid $13.65 per share, which equals about $6,800. Now, what that does is it gives me the right, but not the obligation, to buy somebody's TQ shares at 41. I picked the June 2024 expiration date. So what that means is when I execute this trade, where I buy the right but not the obligation to take somebody's shares at 41, and I pay them $13.65 per share on April 18th, I basically have 3 months to use this paper, this Leaps call option, to write near-term covered calls as if I own the shares. Now, of course, you have to have your account set up. Go to your brokerage. You're going to have to ask for, I believe, level 2 options trading. And what that means is you're going to be able to buy a Leaps call option, which then will allow you to write a near-term covered call as if you own the shares. What you really own is a piece of paper that gives you the right to take somebody's shares at 41, and you paid that person $13.65. And then ultimately, when the Leaps call option expires, we're going to do one of two things. We're either going to sell the Leaps call option outright, profiting or losing, or we're just going to buy this guy's shares, paying him $41 a share. Now, that's not what we want to do. What we want to do is use this paper to allow us to write near-term covered calls where we only use $6,800 in the near term. Now, we're going to talk about this right now because I actually have a trade right now that you can follow. So this is the TQ's trade. And what I did was on April 18th, I went ahead when the stock was trading at 52.98. I looked at my options chain and I looked at a June 2024 41 strike Leaps call option. Now that turns out to be the 85 delta. And this is very important for a lot of you new Leaps call options or poor man's covered call traders. We need to understand why the Leaps call option is so important. In fact, this might be the most important part of this trade because when a stock moves, it moves $1 up or down. That's obvious, right? Well, when you buy a stock, it's going to move 1 for 1. Again, that's obvious, right? Well, when we buy a Leaps call option in lieu of buying the shares, well, that Leaps call option has a delta. And that delta basically represents how much it'll move, or this right here, this cost, this value, which is $13.65, how much it will move based on a $1 move in the stock. And in this case, we're going to break this down here. In this case, when I bought the 41 strike and I paid $13.65 for this Leaps call option, it had an 85 delta, which means I understand when the stock moves $1, my Leaps will move 85 cents of that. Now that's very important to understand because if the stock rockets higher, well, my Leaps call option will trail it and it'll trail it by about 15 cents. Now we'll explain why that's so important here in a minute. But I just want to get the basics down because what we've done is we bought a piece of paper that allows us to buy somebody's shares at 41. And ultimately, see, this is where it's not scary. Ultimately, we will sell this piece of paper for a profit or a loss, or we'll just buy this guy's shares at 41. Okay? So there's nothing scary about this. Now, with that said, let's go ahead and talk about the trades that I've put on. Because right now, I have the right to write covered calls. Because I have that piece of paper, I can write covered calls as if I own the shares. So this is where this little crumb collector idea comes. We're going to go ahead and use a 3x leveraged ETF, which gives us 3x the premiums. So that means the stock is volatile. And we're going to use a poor man's covered call trade, which ultimately allows us to leverage a Leaps call option, basically spending less, to write near-term covered calls as if we owned shares. With all of that knowledge, with all of that information in hand, now let's talk about what we're doing. We're not going to write a near-the-money covered call because here's the deal. We can collect max value if we write an at-the-money covered call. We all know this. Well, the problem is 3x leveraged ETFs will rocket higher and dive lower than typical stocks do. What we don't want to have happen is the stock rockets higher and our Leaps call option does not keep pace. Right now, the TQs is trading for 52x. If this thing pops to 62x, I want you to start doing the math. That's a $10 move in the stock, but my Leaps call option only moved $8.50 of that. Now, I'm going to explain why that's so important here in a moment, but you have to know your calculations. You're not getting a 1-for-1 move in the stock. When this thing pops to 62, our Leaps call option value, which is ultimately going to be the sale of the stock in this case, right? Remember, we're using the Leaps call option to simulate stock ownership. So in a typical covered call, this is where I really want you to focus. In a typical covered call, you buy the shares at 52.41. And when the stock rallies to 62.41, you will be giving up your shares because chances are you wrote a covered call lesser than 62. And that's fine. Just hand over your shares. The market maker does it for you. You collect all the money. Well, when we're using a Leaps call option, and that Leaps call option moves 85% of a $1 move, we could have trouble here. And what I mean by that is this. As the stock rockets, we're going to probably buy this option back. And when we buy the option back, it's going to cost us 1-for-1. Meaning the stock moves $10, To buy this option back to close it, we're going to have to pay $10. Well, that closes the near-term covered call. Now we're going to sell our Leaps call option to pay for all of the trade. Well, now you're starting to see it. Now our Leaps call option did not move $10. It moved $8.50. So our profit projections are missed because the stock moved $10. Our Leaps call option only moved $8.50. The calculator has all this built in, but I want you to understand, it's very important. We cannot let a poor man's covered call with an 85 delta leap run with the bulls, because at some point we start to lose money. Yeah, that's right. We make money on the front end, but if this thing were to rocket 20 points and our Leaps call option's only moving 85%, you could see where I'm going to have to make up the difference. The difference being that 15 cents, or multiply that per share and multiply that per the move. So where we're making money, if we can keep this trade near our strike price, which I'm going to show you in this case, it's about 58.50. Hey, that's fine. We can have our profit projections pretty much work out the way we think they're going to work. But if this thing rockets 20 points, you throw that out the window, because now we have to close the trade. And all those numbers are based on a 1-for-1 move. Your Leaps call option moved 85% of that. Now, let's get back to the core, and here is the idea. And this is what I'm doing. I went ahead and bought that Leaps call option to support this trade. You have to have something to support the trade, because if this thing moves higher, you're going to have to buy shares naked, and you're probably going to lose your ass, so we don't want to do that. You never want to write a covered call without having the shares. Now, some of you do, but I'm not, and I suggest you don't. So we buy the Leaps call option to support this trade, because as the stock moves higher, your Leaps call option moves higher. See, I paid $13.65 for it, but that's when it's trading at $52.98. If this stock moves to 62, my Leaps call option will move essentially 85%, or in the case of this covered call, which I just wrote, the 58.50 strike when the stock was trading at about 52.10, it's going to move about $5.43. The stock move will be $6.38. That is an 85% move. We understand how Leaps call options and their delta affects our profitability. The crumb collector idea is so simple, and I'm going to actually do this more and more. What we're going to do is try to find these 3x leverage ETFs that are trading at the bottom of their trading range. So I want you to imagine a stock like TQ's, which recently has traded as high as 62. It's trading near 52. So if I'm going to get involved with this, I'm going to go ahead and do it when it's trading at 52, not 62, because this thing can fall. And it has fallen pretty hard. Remember, the TQ's is a 3x leveraged ETF to the NASDAQ. So the NASDAQ has fallen hard recently. Well, this is when we want to come in and get involved when it's trading at the bottom of its range versus at the top. That's where most traders get in trouble. And with the poor man's covered call, it's amplified. Because here's the deal. If you buy the shares at $52.98 and the stock moves 10 points down, hey, that's going to hurt. That's 20%. But imagine your $13 Leap call option falling that much. You will literally see this thing cut in half. And if you can't handle that emotionally, then you shouldn't do the poor man's covered call. What you need to do is change your mindset. The mindset is not, where is the Leaps call option priced? Not at all. You never think that. You think of, where's the stock trading? Because see, when I got involved with this, the stock was trading at $52.98. If it's trading at $52.98, chances are my Leaps call option will be worth what I paid. And if the stock fell tremendously, well, it may not be near where I bought. Because remember, when the stock rallies from wherever it fell, and say it fell to 42, well, the stock has moved 10 points, and my Leaps call option only moved 85% of that recent move, which may not get us back to $13.65. You have to understand this, but what I want you to try to focus on, the mindset. We're buying when the stock is at the bottom of its range. I'm not saying a stock can't continue to fall, but for the most part, I think by buying it near the bottom of its range, we have a more favorable chance that the stock will recover and trade sideways to higher. And that's what we're hoping for. Never get involved with a Leaps call option or poor man's covered call trade when a stock is at the top of its range, because Wall Street takes profits. And when they take profits, you get hammered. And because Leaps call options are a fraction of what the share price is, but they move based on the delta, you could actually feel like you are getting crushed. I have Leaps call options that are literally down 50%. I'm not worried about that. All I'm worried about is where is the stock trading, because that is the flag we're shooting for. Right? If I can get out of this trade when TQs is trading in and around 52.98, chances are my Leaps call option is trading in and around 13.65. And if I make money on the Leaps call option, that's good. If I don't, that's okay. It's the premiums we want to collect. Remember, a poor man's covered call trade is mainly a premium collecting trade. We want to use it multiple times. So that means we're putting on trades, we're buying them back, we're putting on trades, we're buying them back. That is the idea. We're using the ability to buy somebody's shares 3, 4, 5, 6 months out. In the near term, we're going to write covered calls. It's a crumb collecting trade. So looking at my current trades, what we've done is this. When we got involved here, we wrote that first covered call. And you can see I do it immediately. A lot of people ask me, do I wait? No, I don't. We write it right away, because otherwise we're just speculating. We're not going to speculate. So we write that covered call. And notice I picked a covered call that was about 3 weeks out. It was trading at 52.98. Now, I did not pick anything near the 52.98 strike because I want this to be a mere crumb collector. So that's what I did. I went to the expected stock move calculator and we dialed up what a May 31st expiration would be by plugging in the current stock price at the money IV, which at that point was 53%. And you can see it's 29 days. And the expected move was from 52.42 to 60.24. So that's where I want to place this covered call strike, because I want it to collect a nice little crumb and we're going to move on. And that's what I did. I picked the 60 strike. We got paid $1. And you could see, although I bought it back early because the stock market has fallen, I went ahead and bought that option back, alleviating the obligation to give my shares away at 60. We then turned around and pocketed the $400. But more importantly, we do the same thing. We repeat and rinse. When the stock's trading at 52.10, we pick the 58.50 strike. We get about $1. We're going to do this time and time again. But what's important is we're going to stretch out those strike prices. We're not going to do it near the money, because if the TQs rips higher, my Leaps call option is not going to stay close, because it moves 85% of a $1 move. So let's put that Leaps call option price way out here, collect about $1 every single time, and we can collect $400 to $500 on this trade every single month. And we've only invested $6,800. This is a crumb collecting trade using a 3x leveraged ETF, which is going to give us 3x the premium when we write a covered call. We're then going to use the poor man's covered call, where we don't actually buy the shares, yet we buy the paper to buy somebody's shares, which gives us protection. But because we only spent a little bit, we're going to make more cash on cash gains. Now we're going to manage this correctly. See, if you're out there and you do this trade and you literally drop in an at the money strike, having a Leaps call option that is 80%, you are going to get kicked in the ribs when this thing runs higher. Because remember, we're buying near the low, and we're talking the NASDAQ. And Wall Street has recently sold the NASDAQ off, and they're probably gonna move it higher, right? Wall Street always comes back. They look for value, and that's what we're doing. It's trading at 52. This was recently trading at 62. So we want to find value in our trades where we have a more favorable chance they can go higher. And if they don't go higher, well, they're not going to fall off the table and this thing goes from 52 to 42. Now, it can go to 42 and 32 and 22. That's proven over the past 2 to 4 years because of, if you remember, that's exactly what happened. But in this environment, it just seems that 52, for me, might be a nice spot to get in. So that's what I did. So that's what we're doing. We're writing these deep out of the money covered calls in the hopes that the stock moves higher and I can manage the trade, right? If I were to write a covered call here and put that $60 strike out and this thing goes to 60, that's an $8 buyback. And I don't want the market maker to take my shares because they're going to slap me with a short sale based on the 52, 53 strike. That means I got to pay from 52 to 53 all the way to 60. That's a $7 move. I have to pay 1 for 1. So when I pay to clear that trade, I'm going to use my Leaps call option to pay for it. Well, what's the problem? I'm going to lose money because my Leaps call option only moved 85%. Now, if you want to go and get a deeper in the money Leaps call option and your delta is now some 95 or 98%, which I usually use, then this isn't such a worry. So, learn your deltas when we're talking Leaps call options because that truly affects your trade. So this is the crumb collector idea. I have one of them going right now, and I'm going to use the expected stock move calculator, which is built into your tracker, and we're going to determine what that strike price is going to be, and we're going to do about a 29 to 30 day trade, just knocking it down, collecting little tiny crumbs. And here's the deal. I'm going to take every single one of those crumbs, just like I did today, and buy a dividend paying stock. And what we're going to have is the semi-passive investment strategy of writing covered calls, and we're going to put that money into a passive investment strategy, paying us month over month dividend income. Hey, look, I know you might have questions, so feel free to ask or comment below. But if you feel comfortable doing this and you want to send me a paper trade, you can do that too. Hey, look, do not get involved in the poor man's covered call unless you understand everything. Now, there's not that much to know, but there is stuff to know. And that's what I hope to guide you through your poor man covered call trades. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.